Mayuresh Joshi of Angel Broking is now with us. Mayuresh, Reliance Industries has by far been one of the outperformers of FI, largely in about last 6 to 8 months. Would you buy into that name?
No, again, I think numbers should be very interesting this time round, Pankaj. What they report in terms of GRMs, because Singapore GRMs have contracted close to $7.7, $7.8 because of the decline in diesel, naphtha and kerosene cracks. Having said that, I think it's a long drawn-out process, and in the next 4 quarters, as their capex gets meaningfully played out in terms of capacities coming up, both on the petchem side of the business as well as the refining side, you'll see greater traction in terms of earnings and unconsolidated ROEs. With a large part of telecom capex being over, I think should start getting into the price from FY18 onwards. So again, I think it's a long drawn-out story, but numbers will be very, very interesting this time.
Right, but the focus should more be on the launch of Jio. Once they have launched Jio, the capex would be behind, and the investments that they have done in the last 4-5 years will start to pay off. That'll be something which the street would be happy about.
No, again, largely I think the street is factoring that the capex is largely over, specifically for the telecom part of their business. And in terms of earnings, nobody's really taking earnings into account even for FY17. So largely I think it's going to be a picture on how FY18 plays out. And the consolidated ROEs, which it dipped below 13%, I think because the capex plan is largely over and the new capacities commissioned, as I mentioned earlier, on the petchem and the refining business start contributing meaningfully, I think that would significantly improve the earnings visibility for Reliance going forward. The telecom part, I think one really needs to wait for the launch, one really needs to wait for what kind of pricing comes through. But again, I think a large part of the analyst community, in my opinion, will not price in anything from telecom, at least for FY17.
Right, but you think EBITDA will continue to grow, and that's what the street is looking at till FY18?
Yes, I think, and that's the entire premise behind Reliance at this point of time. The debt that they've probably taken on the books over the past few years, I think that debt will now meaningfully start getting converted into fixed assets. And once this turnover probably starts improving on a more holistic and realistic basis over the next few quarters, you can definitely expect operating leverage to kick in. With that, I think the efficiencies in terms of return ratios should start flowing in as well onto the balance sheet. So clearly, I think the synergy should start being exhibited from the 3rd and the 4th quarter of this fiscal year. And again, FY18 largely will be driven more to do with their 2 core businesses, refining and petchem.
Right, let's talk about PVR. Now, PVR is up 5-6% this time around. Till about 3 years or 4-5 years back, we were not getting big movies coming in the month of April and May because of the ongoing IPL tournament, because a lot of attraction was there. But this time around, we are seeing big movies coming in. We are seeing Hollywood movies getting getting a lot of response here in India. You think PVR is still undervalued, considering that these 2 factors may lead to a lot of earnings upgrade?
Again, there has been a huge amount of consolidation as far as the screens are concerned among the listed players. And with the kind of consolidation that you're probably looking going forward as well, you're still expecting PVR specifically to keep on adding 60-odd screens, and that's what the management has indicated in the quarter gone by. Secondly, I think the content is very, very important. So I think typically quarter 4 becomes a weak quarter because there are a lot of exams going on. There is a lot of stickiness as far as new launches or new movies are concerned in this period. But I think a couple of movies are expected to do well. Now, there are 3 components of income for distribution companies like PVR or exhibitors like PVR, and you're probably looking at how their advertising revenue is going, how their ticketing revenues are going, and how the F&B spends are growing up. So with new launches coming through, with exciting movies coming through, I think the average spends per head, specifically on the ticketing part of revenues, should start growing and increasing. You're probably looking at spending per head in terms of food and beverages kicking up as well. So you're probably expecting something anywhere between 70 and 80 rupees as spending per head on F&B for the greater part of next year. The average realizations on tickets can anywhere be between 180 to 190 odd rupees. The advertising advertising revenue, again, largely on a quarter-on-quarter basis, expected between 40 to 50 crores. Having said that, I think this quarter might be a little bit of a dampener, as I said, because a traditional weak quarter. But I think the pipeline looks exciting for a lot of these exhibitors, stroke distributors. And clearly, I think if one is holding on to the stock at lower levels, he should continue holding so. The caveat being, I think the numbers would disappoint, specifically on the bottom line in case of PVR. But again, I think that would largely be factored in, considering that Q4, as I mentioned earlier, remains weak for this sector.
Right. Can you also just tell that should one look at PVR like a FMCG company, continuously growing year after year, even most of the growth is coming in from the screen addition. Still, you would particularly look at it like a FMCG company?
I think it's a mix, right? I mean, you go for movies, I go for movies, I do have popcorn, I do have ice creams, I do have sandwiches, I do have pizzas. So I think the F&B spends are increasingly going up. And if you look at the management commentary again, I think the kind of layouts that they're probably expecting to increase, going specifically on the food and beverage part to attract more and more customers, specifically spending more on that. I think it's going to be a pure entertainment kind of a scenario. You're watching movies, you're spending on food. So I think it's going to be very interesting on that aspect. And the advertising revenue per screen is something that will be interesting going forward as well. I think with consolidation happening onto the space, clearly the larger players will benefit, and the synergies will be seen probably in how their earnings stack up in all these three verticals going forward.
Right. What do you make of the Tata Steel deal? Do you think that post this deal, EBITDA will see a big bump up coming in, or is it largely factored in?
So I think largely, I think the markets were factoring in savings specifically on the EBITDA front because the kind of losses that they're making on this Scunthorpe plant is well known to the market. So from an FY17 perspective, that savings potential was well factored in. Secondly, I think if you're looking probably in terms of the pension liabilities getting taken over, the kind of book that the debt that probably still stays onto the book, I think that is something that the street still has to comprehend, because even at this current juncture, steel realizations seem extremely low. You're probably seeing still supply coming in from China, so the demand-supply dynamics are still not in favor of a cyclical recovery, specifically from the end-user industries. What happens domestically in terms of the imposition of the minimum price, the imposition of safeguard duties, that might inch up the steel realizations going forward, and that might have some amount of bump up with their Kalinganagar operations coming through the 3 MTPA plant, the iron ore inventory, the high-cost iron ore inventory getting over. So some EBITDA expansion in double digits can be expected on the domestic front, though I think the international scene in terms of pricing still remains a question mark. So I think largely factored in, valuations probably looking fair at this point of time for Tata Steel.
Right. Can you just tell us about, once the entire Europe business goes through, will it be better to look at a company on a standalone basis and take a fresh call, because they still have a lot of capacity remaining in Europe? So only once that's behind, it will be better to take a fresh call looking in at the valuations that time, plus the debt?
Well, yes, I think the enterprise valuation will count for the remaining assets as well. What happens with Fort Talbot is extremely important. And as I said, I think the entire story then will become, if the whole thing goes through, I think the caveat again is when and what happens and what valuation does it happen at, who's taking what amount of liabilities. But clearly looking at what is happening at the current juncture, the sole focus going forward will be on domestic operations. And I mentioned earlier as well, I think you might see an EBITDA bump up happening on the domestic front, though I think the international scene still remains circumspect.
Right. Mayur, just stay on with us. Just wanted to point out Bajaj Corp. It's up 6.7% right now, 410 rupees. They just declared numbers. Numbers, of course, were looking in very weak, but don't know why the name is up 6.5%, 7%. Maybe something that we can, probably we are missing out as far as the internals of these numbers are concerned. But that's a name which is worth highlighting. It's up 7%, 15 minutes to go for closing. Mayuresh, would you be a fan of the agriculture-based companies? So, something like Ascot's, Jain Irrigation, Insecticide India, all of them are buzzing in because of the monsoon expectation, which is expected to be decent, which comes out at 4 p.m. today.
So yes, I think if the IMD predictions are much above normal, I think a lot of these stocks are reacting expecting a lot of spending to come through. And that would be the case in point. However, I think if you look at the base year, specifically in terms of how FY15 has panned over FY16, you're probably going to see FY17 earnings in a much better fashion if monsoons are much better than what one really expects. So in terms of volumes going up for a lot of these tractor makers, FMCG companies, fertilizer companies, agrochemical companies, paint companies, the select auto companies, I think that ramp up would be seen evidently in terms of the numbers going up. Realizations again is a play directly on how demand supply comes through, and if demand is expected to increase with rural spending expected to come through because of good monsoons, the end realizations will improve for a whole host of these companies. So yes, I think if there are good monsoons coming through, you'll evidently see volume growth happening. With volume growth, you'll see pickup in realizations. If that happens, I think you'll already be aided by a low base going forward, and that would have a positive impact with input costs still remaining benign on the EBITDA margins as well as the bottom line for a whole host of these companies.
Right. Mayuresh, did you look at Bajaj Corp numbers? We just, before I asked you, it was at around 409. We just pull up the stock now, it's up about 12% right now. So another big leg up coming in. Have you looked at the numbers, Mayuresh, for Bajaj Corporation?
I mean, No, I did not look at the numbers, but again, I think there was certain one-offs, if I'm not mistaken, so I think need to look into numbers in greater detail.
I'll tell you about the numbers. So 228 crores was the sales versus 236, so there is a decline of 1 to 2%. As far as EBITDA is concerned, that has increased quite a bit. 74 crores versus about 73 on an operational number, plus the EBITDA coming in close to about 76 crores. 81 was what the street was estimating. So margins have expanded. How should one look into these companies? Should margins be in focus now that prices are down?
Again, I think, as I mentioned earlier, for a whole host of companies within the space or the large universe, the margins largely will expand because commodity prices or input prices are still low because of the inflationary pressures that we've seen on a lot of the input costs, on all the input prices. We'll probably see margin expansion happening for a whole host of these stocks. The important aspect to be noted is the management commentary thereof and how they perceive the next year to be. Again, I think the kind of demand environment that one really is talking about, the challenging competitive landscape, and what really happens with volume growth, I think these three aspects are extremely pertinent for a whole host of these companies.
Right. I just saw that they have declared a good dividend as well, a dividend of close to about 11.5 rupees. That's what they have done. It's a 400 rupee stock. You think that's something which can excite the street?
Maybe, I think, and the stock is reacting based on what has come through. But again, I think one really needs to understand these three aspects more in detail. Dividends can be one way of looking at how the stock performance can go going forward and what the management is in store or the expectations of the management in terms of core operating performance. However, I think I'd like to hear from the management on all these three aspects.
Right. Mayuresh, we'll keep trying the management and get some perspective from them as we are speaking. Bajaj Corp is at the day's high. We're taking a break. We're coming back in 2 minutes. Markets continue to be slightly better off than what they were from the day's lowest point.